Good morning, everyone. I'm gonna take a few minutes to let everyone come in. We have over 100 people registered for this session with Lori, so we're really excited.
That is great. Glad to hear it. This is our second show of our new program that Lauren's going to be telling you about.
Yes, and first let me start with good morning, and my name is Lauren Simpson. I am joined with my colleague, the fantastic Lori Williams. Good morning to you, Lori. Thank you for joining me.
Thanks. I'm glad to be here. Excited to be here.
Oh, and good morning to you, Alma. I see your message in the chat. Okay, I'm gonna let a couple more people come in.
Recordings from last week. I think those are online yet. I'm not sure. I know eventually we're getting there. Lauren, where are the recordings from last week?
For now, we're looking to, okay, so we will eventually have them up on our YouTube channel. But for now, if you guys could send an email to lsimpson@lbcc.edu, I'll get a link over to you. I'll put this information in the chat as well. Oh, I guess let's go ahead and get started. I'm going to share my screen.
Okay.
Good morning, everyone. Again, my name is Lauren Simpson. I am joined by business advisor and financial expert, Lori Williams. I'm going to give you guys a little background as to who we are and what we're doing here this morning. So we are the SBDC, or the Small Business Development Center. We're a national program with over 1,000 locations throughout the country. So in any state that you're in, more than likely you have a local SBDC office. We offer no cost services to local small businesses. So that means you. For the Los Angeles network, we have 8 locations, throughout the area, as far reaching as Camarillo, Santa Clarita, all the way to Pasadena, down to Torrance with El Camino College, and then right here where we're located in Long Beach, California, at Long Beach City College. Again, what we do, we offer no-cost business advising, and we also have virtual trainings. That's exactly what you're attending today. It's a virtual training run by Miss Lori Williams. And, it's our new show. It's called SmallBiz Talk, and it's solutions for your small business. And this is where Lori is able to bring in her expertise as well as special guests and just answer all the questions and bring up all the topics that small businesses kind of, come against when trying to operate and be successful. Lastly, if you're looking to contact us or any of your local SBDC offices, the phone number for the LA area is 866-588-7232. And then you can also reach us by website. It's smallbizla.org/new client. Again, for Small Biz Talk, for our session this morning, please enter your questions into our Q&A. And that way we can be sure that we are, seeing them and answering them. And then anything in the chat will not be necessarily monitored until later on in the show. So again, if you have questions, please enter them into the Q&A. And I'll hand it over to you, Lori. Good morning to you again.
Excellent. Thank you. And good morning, everybody. Now, last session, we started talking about the pandemic cash flow. We're going to continue talking about that. So give me a few minutes while I switch over and share my screen. I was telling Lauren that last night, Microsoft decided to upgrade everything. So everything on my screen has changed. It's going to be a fantastic morning as I search around trying to find things. So once again, welcome to Small Biz Talk. Very excited to be involved in this. Oh, and let's see. And like I said, if technology is troubling this morning, it started doing all kinds of new things last night. So the concept between Small Biz Talk, it's going to be a weekly talk series. And as Lauren said, each week we're going to talk about a different business topic. Sometimes I'm going to give you information. Some weeks are going to be a little bit more heavy in data and instruction. Sometimes we're going to have guest speakers coming up. These are going to be real life situations. So it's kind of got a variable platform that's going to be fun and inviting. And I'm going to give you a little bit of an update on what's going to be happening in a couple weeks. Here's a little bit of information about me, just in case anybody wants to know who is this person that's talking. A little bit of my background. But as you're looking at my background, I'm going to tell you about an exciting show that's going to be coming up in about 2 weeks. I'm going to be interviewing some guests that had to change their business model significantly due to COVID. And what happened as they changed their business model, they actually went down a new pathway that they found some great success. So we're going to talk to people who actually benefited by default through the experience of COVID. It's going to be interesting. You'll be able to take away with some finer points on things that you can possibly apply to your company as well. So today what we're going to do is we're going to talk about the pandemic cash flow, understanding your cash position. Now you're going to hear me constantly talk about the fact that you really have to have a strong understanding of the financial health of your business and your cash position. So many small companies that I talk to on a daily basis and across the board do not have a comprehension of the financials in their company. A lot of times people don't know what to do. Sometimes they think, well, my company's small, I don't need to understand this aspect. And that is simply not true. I always tell people that not having a full understanding of where you are financially within your company is asking for trouble. Now, I understand why small companies don't. It's complicated and confusing, and they don't have a lot of people that will take these financial tools on a higher level and tell them how to adjust them into your small company. And that's my forte, is saying, okay, here's what you need to do for your company. Let me explain it in simpler terms. Today, that's what we're going to start talking about. Hold on, for some reason, it just doesn't want to click every time. So what we're going to go over today is an aspect to understand the role of finance in your company. I am going to begin by just explaining some basic principles, some basic concepts. I just want you to sit back and kind of go, okay, I never thought about it that way. Another way of me saying what I'm going to do is I'm going to get you into a room right now of understanding and looking at things different. So when we talk about understanding the role of finance in the company, we're going to talk about 2 concepts behind accounting. Now, as I'm explaining this, take it in, understand what I'm saying. This isn't something to memorize. This is just like, I like to refer to it as if you were learning algebra. And I was to say to you, A plus B equals B plus A. And you sit back and think, okay, not sure why that matters, but I'll accept A plus B equals B plus A because I may be applying that somewhere down the road. In that same vein of thought, I would like to explain the following. When it comes to accounting, there are 2 concepts in accounting, 2 purposes in accounting. This is not something that is ever explained to small companies. And so it creates some confusion about what numbers to use, what finance means, whether it's financial statements, etc. So the first one we're going to talk about is financial accounting. When I speak about financial accounting, I'm talking about the preparation of financial reports for external parties like a creditor, for an investor, for government authorities, anyone who requires financial information about financial performance. I want you to think tax returns, bankers, investors. Now, in this aspect, financial accounting, the financial data needs to be aligned properly within a presentation. Many people are familiar with the income statement. It has to have the revenues, the cost of goods, and then the expenses, and then the net income. It's aligned in a certain format that it must fit within for presentation to these financial reports. And most people are familiar with financial accountings. They'll say QuickBooks, my QuickBooks report, or my tax returns. They get this. The part I'm about to communicate next is something they're not as familiar with. And this is managerial accounting. Now, the main purpose for this, notice it's highlighted. This is the part I want to bring up. It's internal decision making and financial control. This area here, you don't hear small companies talk about. You don't say, well, I have my managerial accounting documents for internal decision making. Now, you may have some, because you have things such as sales and prospect reports. You may have a customer report, but a lot of times in the financial arena, people do not have any type of separate reports that they're utilizing to identify the financial health and the profitability of the company. This is to the detriment of the company. So what we're talking about today is some of these internal reports. I'm going to be specifically talking about a cash flow, but as I have my weekly show, I'm going to bring up this topic many times and discuss different reports you can do internally. So in managerial accounting, what managers must consider is what data is pertinent to the organization's financial health, and you establish reports and controls to measure such performance. So I want to say this immediately before it even comes up. No, there is not templates. You have to create templates. You have to get a concept. You have to understand. You have to know what you're trying to figure out, what you're trying to measure, and what report will do. And this is why you don't have small companies engaged in managerial accounting, because they're pulling up a template from someplace, and these aren't about existing templates. These are about creating templates. So this is a scary thing, guys. So I know it, and I'm not expecting you to understand this. What this is a snapshot of the kind of more elaborate template that I would use when I was the CFO in different companies. And I'm just expressing this right now so you can get a feel for it. What I would do is I would have to manage the cash flow on a weekly basis. It was a rather large company. They didn't have a lot of strong cash flow, so it was a matter of really who could we pay when. So what I would do is, I was the interim CFO, as I was and am for many companies, is I would have the person internally fill out an elaborate format structured Excel document that I created based on what I wanted to measure. And in this case, they would have to tell me, what's the accounts receivable? What clients are paying us? What are the terms? When are they going to pay us? And when do we think we'll get paid? What are the accounts payables? What do we owe? And then what are other expenses? And then I would have all the overhead. I could change this and see, red is, okay, we're not going to have enough cash for that month, but do we have enough cash in the bank to pay? And then what I would do is I would identify, okay, if I pay this much in accounts payable here, or this much in accounts payable here, or this much in accounts payable here, where will I be financially? And I could make these numbers change to identify about where I would be. And then what I would do is I would say to the controller in the company, this week I am allocating, and I might say to them something like, you got 150,000. That's what you get. You get 150,000 to pay anybody that's a payable, any vendors that we owe money to. You determine who you're going to pay. Another way of saying this is you determine who we're not going to pay by who's really complaining a lot. I hate to say that, but this is true. This is what happens a lot in companies. And if you ever called somebody to find out if they're paying your bill, you might have heard something like, well, the CFO has allocated these amount of payments. Please check in next week. We'll be cutting checks then. Because every week I would allocate a dollar amount, and that's how it came about. So this is a very elaborate example of something that I would do, but you could see I was using it for internal decision making. So if I found out, well, this person wasn't actually paying us here, they've been stalling on paying us, then I might move numbers here. But it was a way for me to allocate cash flow on a weekly basis to then provide the controller with a number that she was allowed to spend for that week. Okay. So that's an elaborate example. Now, the one thing you have to understand is for these reports to work, data must be extracted from your financial reports and aligned properly for the analysis. It's not that you're going to have the ability to just extract this from your QuickBooks report. You have to actually take data and figure out, what am I trying to measure? What am I trying to determine? What am I trying to understand? And then you have to extract that data and align it properly, like I did in that elaborate Excel sheet. So what we're going to talk about today is, what type of data do you need? And then next week, we're going to continue this conversation. So I'm going to invest enough time in this process that we're talking about for this cash flow the next 2 weeks, so I can address questions. You can think about what you're hearing today. You can go back and extract some more data, etc. Okay. So that's where we're going. Now, one thing I want to say is, don't worry where your information is. You may be using QuickBooks, you may be using Excel, you may have it in a shoebox, you may have it in file folders. It does not matter where you have this data. It's just a matter of allocating the data. So let's start out by pandemic cash flow. This is a word that I developed. This concept was developed by me. What is it? How does it differ from a cash flow? Why did I call it a pandemic cash flow? And what information do I need? So let's first go there. So what is it? It's a financial tool to determine your current and future cash availability. You know, you have to make sure, whether you're a company that's just knitting doggy sweaters, cat sweaters, and selling them at the flea market, or you're a restaurant, it doesn't matter what you are doing. You have to know, do I have enough cash to pay today's bills? Do I have enough cash to pay future bills? Unlike when you get a salary and you say, well, I get paid this weekly and I got my house bill and I got my gas bill, that's very static. It's easy to say, as long as I'm employed, I'm getting this paycheck, my house bill is this amount, I know I can pay my house bill. But when you start a company or involved in a company, things are very dynamic. You have to determine, what are your sales? When you get the sales, how much is profit left over after you pay to produce the product or service to pay bills? If you offer any kind of payment terms, allow them to pay in 30 days, 60 days, you have to determine, when am I going to get that cash? If you have to pay some of your vendors up front to maybe get raw material or labor to produce the product or service, you have a gap between when you have to pay out the cash to pay the vendors and when cash is coming in from the clients, the invoices. What happens is, if you have enough money in the bank, that gap kind of works out okay. You pay the vendors here, you get the next money, you pay the past vendors, you get the next money. But the minute something happens where you don't have new money coming in, a pandemic, it could be a loss of sales, it can be a ton of reasons. This happened before the pandemic. Suddenly your cash flow isn't what you expected. So that's why you need to be able to identify your current and future cash flow, and you have to identify it based on, what do I owe and what may happen in the future. Now, when you look at a cash flow, you have to consider what cash is in the bank, what your current bills, what your future bills, and then also what is your current and forecasted income. So I'm doing a bunch of different things. Once again, think dynamic, moving things rather than static, just steady. I'm figuring out what's static. I got this much cash in the bank and I know I owe this money. So this is my bills and this is how much I'm currently getting on invoices. But then you're thinking dynamic, but I got these future bills coming up and I got forecasted income. So you have to mix these two things together. And so what happens is, when you figure out how to create something internal for your company that allows you to look at this on an Excel sheet. It can be a piece of paper with a calculator. I just like Excel, but it allows for more informed decision making. Now, why did I call it a pandemic cash flow? And that is because I always had a cash flow, but in the pandemic, it really, really complicated situations because it had to give an ability to determine the current cash flow availability, what's current, and predict these future cash availability based on scenarios. And this is what I'm speaking of. Let me use a restaurant for an example, because that one is easy to explain. Say that the restaurant had this much money in the bank and these many bills, and then it opened, but it opened at only 1% capacity. That's a whole new situation than previous to the pandemic, where they could say, well, typically I have this many sales, etc. Then all of a sudden, new legislation came and they had to close. Well, now they had to go on whatever current cash they had to pay all of the bills. Then they got to open again and maybe eventually open at 100% capacity, but behavior of people afraid to go into restaurants, they didn't all come back into restaurants immediately. So the pandemic cash flow was different from a regular cash flow that I normally would have created with these variables, because I had to have it be able to be almost a genie in the bottle and predict all these future scenarios and say, well, what if this happens? And what if that happens? And what if that happened? And early on, when I was working with clients for the SBDC, and we're trying to figure out sometimes very hard questions, should I stay in business? Should I not stay in business? It was really imperative that I tried to figure out a scenario that we could say, well, if this happens, then this would look like this. When this happened, when this will look like this. When this happens, it'll look like this. So I had to become more clever in my cash flow, which was already pretty cool models that I had created, to engage in this pandemic cash flow. And why am I talking about it today? And why am I starting my show off with these type of discussions? Because we're at a point now where a company may be open for 100% capacity, but it may not have the behaviors of all the customers coming back. It may have a supply chain issue, as we're having. All these things are going on, and they may have gotten PPP funds, idle funds, grants, and all this has mixed into this big pot, if you will. And most small companies, if not all, don't really have a handle on where are they now? Where are they financially? Where is their cash flow? And so you could be going forth thinking you're okay, just to find out you're not. And so I become almost on a soapbox saying it's really, really imperative that everybody gets a good handle on where they are financially and has better internal tools to be able to identify where they are financially. And that's why I'm talking about it in my first up to, my next two shows. And I started talking a little bit about it last week to kind of give everybody a good foundation. Once again, Lauren's going to put information on how to get in touch with us. You're able to make appointments to have more one-on-ones to go over this that we're speaking of. And I just want to make that mention now in case anybody's sitting there going, oh my God, I'm so overwhelmed. I'm going to try to answer questions through my show. I really am going to do everything I can to get everybody to understand how to use these tools. So with the pandemic cash flow, it's a lot of what I said already. Think uncertainty. Many companies are struggling with unknowns. Situations change abruptly and they cause these immense shifts in revenue. So I felt as though we needed to analyze these to make informed decisions. So what do you need to know? This is the data. This is where we're starting to get in the weeds from that expression, guys. So this is where we're going to get into a little bit more heavy thinking. So this is where we're saying, what is it that the data that you need to know? With the data, you need to know these following things. You have to know how much cash you have available in a bank account. Now, notice I said not from an online bank account. When you look online, say my online bank account says I have 10,000, okay? I may have payments that I've already made that have just not come through. I may have automatic withdrawals. I may have written checks. So you can't know just what's in the bank account. You have to know how much cash has not been already allocated to an existing bill. You must know that. You must know a monthly listing of your current overhead bills. You got to know what is actually my bills that I have on a monthly basis. And you must have a listing of the receivables. Now, receivables are money that customer owes you. Now, a lot of small companies don't have payment terms. They have credit cards they use, and you get that credit card payment within a couple days, so you would not have receivables. But just in case any companies that are listening, any business owners that are listening to this, if you have where customers owe you money, you have receivables, you have to include that. So you may have receivables. Now, 5 and 6, we're going to spend some time with at the end. This is the complicated portion of this. You really have to understand your gross profit margin. It could be an average. And I could spend a whole lecture on gross profit margin and how you must understand how much of a percentage of your sales goes towards making your product and service. This one area I find is least understood by small companies, and it's to their detriment. So I will be talking a lot about the gross profit margin, what this really means, and why you have to understand it. And you also have to be able to forecast sales, but because it's got this weird pandemic cash flow that I created, this overlay, you can include variables and probability. So this is the list we're going to go over now, so I can explain this in more detail to you. Okay, it wants to tell next this time. So the first one is cash in the bank. This one's really easy. And all you need to know is how much cash is in the bank account, but it can't be just online. It's got to be your checkbook register. And also I wanted to make a note here is Lauren is going to send this PowerPoint presentation out to everybody afterwards, guys. So anybody that signed up for this, we got your email, you're going to get this presentation. I wanted to make mention of that. So what I'm saying, not your online, what is actual your cash, you need to make sure all the checks and the direct withdrawals have been subtracted from that amount. If it's mid-month, like say it's mid-month, I got $6,677, I might turn around and say, well, by the end of the month, I have maybe another $1,000 in bills. So my real number I'm going to use is 5677 because I have this $1,000 in bills that's coming through, and I'm going to start my forecast at the end of the month. You have to know what you have left over that has not been allocated as the starting number that you're going to be using in the cash flow. And that's where you can subtract this, and or you could subtract it into the cash flow itself, which I will show you in a minute. But all this slide is telling you is that you got to say, okay, if every single withdrawal that came through for this month, every single check or whatever date you use, it could be a mid-month date, but whatever date you use, you got to make sure that that is the cash available. It has not been allocated to another bill. So you might create something like this, a list, and you'll say, okay, this is the due date that this is. You know, you can say, I pay this on the 15th of the month. It's my Verizon, and the monthly amount is this, and times 12 is the yearly. So you want to make a chart. It can be, once again, you can do an Excel. You can do it on a piece of paper. You can have your kids' crayon and some scribble. It doesn't matter. It's getting the data, right? Now, if you have a payment that's been delayed or reduced, like say you have an idle loan and you don't have to pay it for 6 months, you want to put in there idle, and you want to, if you have an idea of the monthly amount, if not, just put an X there so you know that's coming up. It's called a placeholder. If you don't know an amount, at least just put an X there to say, I know it's going to come up, so you are not forgetting any bills that are going to come up down the road. So this is just a listing of all your overhead bills. Notice I said overhead bills, not vendor bills that would be paid out to make your product or service. In the easiest example I can tell you is, say I made chairs. I'm going to buy wood, and wood's going to be in the inventory that I have. I may have extra wood, what have you. Or say I'm a distributor and I buy chairs and resell them. I'm not going to pay the amount for the chairs every single month. Say that I pay independent contractors to do something and I only hire them when a project comes up. I'm not going to pay this every single month. So these are overhead bills on a monthly basis, not to be confused with something you're going to pay, which is a product or labor to make a product or service. So an example, just an example of what this could look like is you'll have these type of overhead bills. So you can see a listing here just to give an example. I put month 1, month 2, these can be actual months, and you're saying this is how much I pay for each of these on a monthly basis. And over here you have a total. So really all I did was take this concept that we have here and I just extended it to each month to give you a view of what it looks like. Once again, notice that this is just overhead bills. These are not vendor bills. So the very first data that we're talking about, this one's pretty easy to grasp. It's just putting a list of your overhead bills. If you're looking at your internal QuickBooks account, you can extract this information under expenses. You want to do a double check because maybe you paid something in this last year that you're not intending to have to owe. We're looking at going forward, so you want to understand that. Also, if you make the payment in a quarter or once a month, or not once a month, but every other month, or maybe you have an insurance payment and you only pay that insurance in month 6, you want to write it in month 6. So you don't take this and divide it upon every single cell to see what it would cost you every month. If you pay your insurance only once a year and you pay it about month 6 or month 1, you want to put it in the spot. This is saying when the money will actually have to be paid out. We're not doing a cute little forecast where we divide everything by 12. Yes, I did it here just to show you, but we are literally saying, I must make the payment in this month. I must make the payment in this month. These are actual payments having to be made. Now, for those who have accounts receivables, customers owing them money, and accounts payables, you want to record when you expect to be paid. You don't want to include anything that you say, well, they owe me money, I don't know if they're going to pay me. Don't include this. We got to get as close to the truth on cash. And you want to know, are they going to pay you in 30 days? Are they going to pay in 60 or 90s? You can make the list really long so you can understand who it is, or you might say that I expect to get this much by 30 days, this much by 60, by 90s, or I have to pay out. Now, these would be bills that are already in existence, okay? These are bills that you already owe. Let's go back to my chair example. Say that I'm starting to build my cash flow and I purchased a bunch of wood to make the chairs. And I was given terms by the vendor. And so I owe currently, as I'm putting together my data, I'm collecting my data, I know that I owe this vendor $100 and I must pay in 30 days. I'm going to put it there. I owe the vendor money already. So this just has to do with customers that owe you money, and it has to do with vendors that you owe money to that you have to pay. Some people may not have this area and then you just exclude it. But if you do, you want to figure out how much is going to be owed and when. And so basically what we're doing is we're starting to create an Excel document that is going to have, this is the accounts receivables, this is customers that owe you money, customers that owe you money. This is the accounts payables, you owe money, and this is the overhead bills. So I might have something like Verizon here. Excuse my writing on this. I might have something like rent here, right? And then I'm going to say, okay, I have accounts receivables. I think I'm going to get $100 here. I have to pay somebody $100 here. And I have Verizon, which is $50 every single month. And my rent is, I just use small numbers, just to explain, is $100 every month. So all I'm doing is I'm saying, and I'm filling this out to say, where am I? And I'm just using month 1 and month 2 to give you an example. So when I look at the net difference, this is how much money is coming in, just in my thing that I'm showing right now. We haven't added sales yet. How much money is coming in versus how much money is going out. Well, I have no money coming in, no accounts receivables, nothing is here, right? Accounts payable, I owe, it's money going out. It's a negative, right? It's negative. I have Verizon, I owe, that's money going out. It's negative. I have rent going out. That's money going out. It's negative. So if I simply add this together, I have 250 in negative, okay? Negative number. I have got $250 going out, nothing coming in. Now, let's stay with this net difference. In this case, I got 100 coming in. That's positive. I have no money coming out for accounts payable, no negative. I have money coming out, that's negative. I have money coming out, that's negative. So if I have 100 coming in and 150 going out, I have negative $100 or $50. So you can see all I'm doing is getting a feel for what is the difference in the column, what's going to be left over once it comes in. Eventually, we're going to add a sales forecast and the bank account balance here. I'm just showing you how this works. Now, if I had $1,000 in my bank account. Let's just take this and say I had $1,000 in my bank account. When I subtract 250, I got 750 left over, right? When I subtract 50, I got 700 left over. So this is giving me the balance of cash I'm going to have. This is telling me the net difference between the column. It's the net difference in the column, and this is a running total on the balance. And this ability to look at what's happening on a monthly basis and then what's happening in the balance is the special sauce. The other thing I'd like to say at this point is everything I'm teaching you is like the A plus B equals B plus A. Once you understand the basics, you apply the same dance steps, if you will, to everything. Whether I'm doing a startup forecast, working with investors to see if the business model's profitable, working with lenders, working as a CFO, whether I'm dealing with a $10 company, a $100 million company, doesn't matter. I'm using these same basic principles, but I first have to arrange the data. But once I arrange the data, I'm using the same thing. I might do a startup and say, when is it that sales has to come in? How, if sales does this, what happened? It's the same concept. And that's why I like to start bringing small companies into this understanding. They learn the dance steps and then they can apply it. So all I'm showing you here is just the general format that I use and the reasoning behind the logic. So what you have to know, let me go back to this. Let's go back to this. So in this, what I'm going to do in a bit is I'm going to then show you this in a more elaborate demonstration. Right now, I wanted to kind of premise this next slide so I didn't lose you. Right now, what we're going to focus on is this section that I'm saying is going to be in here. And that section is where we're going to add our sales, okay? Because right now I can say, given the current situation with the money I had in the bank in my example, the money I have coming in that I know, I've already done the work, the money I have going out, this is where I'm going to be. So I have the current, but what I expressed to you is that my cash flow can't just look at current, it also has to look at forecast, and it has to look at variables. So what we're going to talk about now is getting in the variables, the sales end of it, the forecast, the variables. This is where it becomes extremely customized to each company. This is where, and why I say, you can't get a template. I can build a template on your scenario with you, but I can't give you a template that you just fill out because you really have to look at your own situation. So with that, I think we're good. I don't see any questions regarding what we've come over so far. I see some questions in the chat, and I'll get to them before we end the show today about other topics. But what we talked about so far, it looks like we're pretty good. If anybody has any questions on what I've discussed so far, about what kind of data we got to get, put it in the chat so I can address it. But I think we're good to go on this. This is where I'm going to take you around the next corner. In order to do this, you have to know, can it be updated, or is it just a forecast? Good question, Ruth. This is the cool part of it, Ruth. It's always updated. Once we build this, this is done constantly. You know how I was talking at the very beginning and I showed you that very elaborate document that I had used before, which is the same principles as this? I would look at that document every week and determine the cash flow for the week. So this is not something you create and then you put away. This is something that you can manage going forward. So this is a tool that keeps growing with you. Good question, Ruth. Okay, guys, this is where sit back, take a breath. We're going to talk about this week. You may have questions. I'm going to answer them next week. This is the part I got to drill down on and help you understand the importance of this. What I'm about to talk about isn't even just about this cash flow. This is about completely managing the finances of your company. And this is where I spend the most time with small companies because they don't understand this aspect. So I would say, you know, if somebody said to me, Lori, there's, in fact, I just got asked that yesterday. If there's one thing you could say to all companies, what would it be? They were doing a spotlight on me as far as, you know, recording some things I say. And I go, you must understand the financial health of your company and your profitability. And this is about what we're talking here. So what you have to know is the gross profit of your product or service. So bear with me. As I tell you, you have to know this. I'm going to tell you why you have to know this to calculate it in this cash flow. And I'll explain it. But for right now, let's just all agree that, okay, Lori's going to say this is going to have to be known in the cash flow. I don't know why yet, but let's learn what she's talking about, how important this is. Now, if you have your business where it's kind of simple, you know, maybe like the chair. I always use the chair because everybody understands what a chair is. Say that I purchase a chair and I purchase the chair fully made and then I sell it. So just for making it up right now, I can say I have a product, I purchase a chair, I pay $35, or I charge, I'm sorry, my customers pay $35. I sell it. The selling price is $35 and I pay to get it from the manufacturer for $17.50, right? So all I'm doing is I'm identifying what the selling price and the cost of goods is. With that, let's explain cost of goods. I'm going to give you the financial terminology of cost of goods, and then we're going to talk about how it applies to different companies. So cost of goods are those raw materials, those expenses, raw material or labor that is used in the production of your goods or service. Used in the production of your goods and service. Now, in that, you can imagine if I make more chairs, I'm buying more wood, okay? So these are variable. They change according to sales. And in finance, we call that they get used up during production. So if I buy wood and I make chairs, the wood's used up, right? It's gone. And so cost of goods has to do with those variables. If I was a restaurant, it could be food, plates, etc. It's not waitresses, okay? It's not the rent. It's not other things like that. That's an overhead bill, right? This is only about cost of goods. Now, I'm a consultant. So in consultant, and I just made up all numbers here, say I charge $125 an hour, okay? Now I have a service and it's an hour because I'm not hiring anybody else to do the consulting. It's just me. For this purpose, now other purposes I consider an hourly rate for myself, but for the purpose we're discussing here, remember I said all the time we're extracting the data and we may be extracting different data and using data different because we have to identify the purpose. So for this purpose, my service has zero cost of goods, okay? Now, say that I sell shirts and pants, and I either make them or I buy them and then I just resell them, doesn't matter. What I want to do is I want to get maybe the average gross profit, because I could sell a medium shirt, a large shirt, a red shirt, a blue shirt for this analysis we're doing. And this analysis, we aren't going to want to get a cash flow statement, a pandemic cash flow statement with a forecast that has every SKU that I have. We don't want to do that. So what we're going to do is we're going to take an average. So you might say that of the shirts I sell, the average price is 55. Or you might say of the pants I sell, the average price and the average cost. And you would just say the average. Now, if you have a shirt that sells for 10 and a shirt that sells for 100, there is such a range here that our calculation could become skewed because of this range. So in that case, you might have my low cost, my mid cost, and my high cost. The reason why I am not doing just an average of one shirt is because the range is so large that it would be skewed. So what everybody has to do is go into their business model and see what they need to do to figure out how to answer these questions. Like, for example, I can go through a million of them because I've done this so many times with different companies, but let's use this one as an example. Picture a hair salon. So I had a hair salon, and what she did was she cut hair, right? And then they dye. And then they had a couple other activities they did. So I said, what is an average cut? What is an average dye? What is an average? And we just took average. And then in one case, she did the cutting. So I put 0 cost of goods when it was hers, but other times she got a percentage based on other hairdressers in her salon. So in that case, I had a percentage put in. So you really have to go into your world. And this is where, if you have some questions, put them in the chat. Even if I don't answer them this week, I'll be addressing them next week as we go through with it. So this is the crux part, that you have to get an idea of what the selling price and the cost of goods are. And you don't want to have this list 20 long. You know, I would say keep it to 5 at the most. And if you have to, you figure out an average from that. Okay, now you must forecast sales. Now, what's interesting is in this model, you're not sitting back and going, oh, is my sales forecasted properly? Do I really know how much I'm going to sell? You can use it based on a variable or must be at least. This right here is the cool part about the model that we're all going to create together, because you can do a variable such as 20%, but when you put the numbers in, you're going to determine I must sell at least this amount to have enough cash flow. So you don't have to be, in this specific application, 100% accurate on your forecast sales. You put something in and then you identify what it has to be in order for you to pay the bills. So I want you to think about it this way. Let's pretend I'm an hourly consultant, okay? And I don't know coming up in the months how many hours people are going to purchase from me. I'm going to just take a consulting model. It's the simplest to explain, okay? So if I look at it that way, I could say that these are my bills per month. Say my bills per month, I make up small numbers, are $100, right? So I'm going to say, well, if I sell my services for $50 an hour, I just pick up things that's easier for me to multiply in my head. I must sell 4 hours. So if I sell $50. I'm sorry, I must sell 2 hours to make my bills, right? So I could say that I must sell at least 2 hours every month to pay my bills. The way you can put this in the forecast is, what if I only sell 1? Do I have enough cash? What if I sell 5? How long will that cash? So you can start playing with it. So the concept is to identify what is the least number that you have to sell in order to pay your bills. And this is really cool because on a large level, what I would do, and you're going to start to see how CFOs use this kind of analysis, I would sit down and look at the company's financial obligations, including our loans and all this. I'm talking $1 million, but it's the same thing. It just has more zeros after it, right? And then I'm going to say the company must have this much profit, gross profit, to cover this. And I know what our average profit margin is. So I must have this much in sales revenue. And then I'm putting all these numbers together. And then I know that the company must meet a annual sales target of, let's say, $2 million. And I know if I don't hit that 2 million, I'm not going to get the net profit, and they're going to call the loans. This is like real big stuff you have to figure out. So then after I know the amount that the company must sell in revenue, I meet with the sales manager and say, how many salespeople do you have? And they say, this many. And I go, well, make each salesperson's quota this amount, because I know if the salesperson each sell this amount, somebody's going to sell more and somebody's going to sell less, then those amounts together is going to be more than I need, making sure I'm going to meet the revenue goals. And then I'm going to say, no salesperson is ever allowed to sell at a reduced selling price that goes below this amount, because I know if they sell at the right number to meet my gross profit, I'm going to have enough. And that's how I do it. And then I meet with the sales manager every month. How are we doing? What's the numbers? What's the numbers? So when you look at larger companies, or even if we want to go to Wall Street, they beat the street. They did this. This isn't by default, guys. This is all well planned and monitored. I want to go into that story of being an airline pilot. You know how you always hear that planes are off course X percentage of the time. Don't know that number, but it's a percentage of the time. But they land on course where they're supposed to land. At least you hope they do. Financial management's the same thing. You're off course and you just keep managing it and you keep doing things throughout the time period. But the importance of financial management, I'm going to say this again so you guys are listening to me. The importance of financial management is one huge word. This is a Laurieism again, choice. If you have a clue ahead of time what is happening and what you need to do, you have time to make decisions. You don't want to look up and go, oh my God, I don't have the money in the bank. We're not going to be able to pay the bills. I can't get a loan. Choice, to me, is my favorite word on planet Earth, guys. Choice gives me time to decide. And the difference between choice and decide is the huge difference between respond and react. Companies that are managed properly respond. Too many small businesses react. Let me give you another example that I talked about even last week. You hear something that the price of gas is going up. A large company suddenly increases their selling price. Well, they've done this because they anticipate the future increase in fuel price, the amount that's going to affect the bottom line and what amounts they have to pass on to the customers. Small companies, fuel prices go up. They just pay a higher fuel, their profit margins shrink, and they make less money. So what I'm trying to do is teach small companies in a very simpler model how to think like large companies, to have more control of their business, to have choice. So in the forecasted sales, what we're going to do is we're going to use a variable, or must be at least, but what you want to do, and I'm putting these together now. So here is what I showed you a minute ago. It's the selling price and the cost of goods. It's exactly what I showed you a minute ago. Well, then I want to be able to say, I expect to sell 5 shirts here, 6 shirts here, 7 shirts here, or we can do it on a basis of percentages. I'm going to get into this chart in a minute, but this is just the reproduction of what I explained regarding you must know your gross profit. Here's where I'm going to start talking about the forecast, and these two must play together to make this work. So let's go into talking about that, which I'm going to switch my screen right now so I can share some examples in the last minute. So what I'm going to be doing, guys, is I'm going to run through something really quick so you get a feel for what I'm talking about. Next week, we're going to pick up again on this. You must know your gross profit and you must be able to forecast sales. What I'm going to do now is explain to you by showing you a visual. Once again, it's going to be a little bit maybe over the head right now, but I always believe that people learn best when you give them somewhat of an idea of the road they're about to walk down. So I always give you an idea of the road you're going to walk down, then I break down how to get there. So give me a second while I do some fancy stuff to share my screen. Just 1 second, guys. Okay. And let me share this. So what I did here is an example of the pandemic cash flow that we're going to build together. I'm going to teach you how to build this. All this is showing you right now is I added the bank balance, okay? So the bank balance is how much cash I have that is not allocated to any expenses, 30,000. Over down here, guys, is just, I use just 4 things. I don't want to make it complicated. So you can see I'm saying I must pay $1,000 every month for rent. But in my little scenario, my landlord gave me a break on my rent. But in January, I got to start paying more to make up for the break that they gave me. So my rent's going to go up to $2,000. So I put that in. I have wages. I have employees in this case. I'm going to plan on hiring some people back. I'm just making up stuff here. Marketing, I haven't spent any on marketing, but I know I need to start spending at least $200 every other month. And I have a loan that's going to become payment, and these are the loans that I have coming up. So that's all I did was filled out the monthly amount. I know that the filling out the monthly amount and the bank account balance, that's the easier aspect. Here is your first introduction to a sales forecast based on profitability. I showed this the last class or the last session, and I'm showing it again just so you can kind of start seeing where I'm going. Say that I determined last year my profit was $20,000 for the year. Now I could have gotten that off my tax return. I could have gotten that off identifying the gross profit. Like I said, this is where you've got to figure out a number, but it's got to be the gross profit, because as I start spending more money on the wood, if I make more sales, the wood is not here in my chair example. There's no wood here. I can't say, well, I'm going to spend $500 a month for wood, because it's all dependent on my sales, guys. So I cannot put a static number for wood. If I hire independent consultants only when I project, I can't put it down here. It's not static, it's dynamic. So that's why I have to already have a formula above here that says sales minus cost of goods equals what the profit's going to be, because that's the cash that is actually left over. So if I identified it based on units or whatever, this is just giving you a feel for what I'm talking about. I can then take a variable. So I can say, what percentage of opening am I going to have? So maybe last year when I paid for all of my expenses like food and plates, if I'm a restaurant, I had about 20,000 left over, and I'm going to use my 2019 pre-pandemic in this specific model I've decided to create. So I'm going to say, well, in this case, I'm making this up, guys. November was closed. And so you simply have 3,000 in the bank minus 1,500 is 1,500. That's the difference. 1,500 is the difference for this column, and 1,500 is the cash balance. Let me go over that again and let me highlight what I'm talking about. So remember, net cash increase is what is the change within the column, okay? So you can see the change in within the column is 0 money coming in, 15 out, 1,500. And then I took the bank balance and said 3,000 minus 1,500 is 1,500 left over. Here's the cool stuff. What I can then do is I can turn around and I can say, well, I think I might only have 5%. Okay, I'm going to lose 1,000. Cash crunch. Problem. And I think I'm only going to have 10% here. Oh, no, that's not going to work. And what if I only have 10% here? That's what I think might happen. Okay, now I can come back and go, what is the least amount? See, when it's red down here, guys, my cash balance, I can be red here and have a difference. But if I'm here, the bank's not going to let me have a negative bank account. Okay. So I can say, what is the least amount I have to have in order to fix this problem? I can literally go 11. Nope, that's not going to work. 12. Oops, I went into the wrong blank. Sorry. That's what happens when you're typing and doing a webinar at the same time. 13. Nope, that's not going to work. 14. Nope, still not going to work. 15. I'm going to need more than that. I'm going to need 18 maybe. Okay, 18. I need 18% capacity to have at least 30,600 in gross profit, and I can actually take that back in order to determine how much sales. My focus of this demonstration at the end is to show you how the pandemic cash flow is starting to combine a forecast variable, right? A forecast variable right here with what I know that I'm going to have on a monthly basis, telling me whether I'm making or losing money in the month and what is going to be my cash balance, which I can see right here. That is going to be a problem. So this is a demonstration of what it will allow. Now, as just a quick run through, on some of these, the idle loan is not forgiven. The advance, which was 1,000 based on your employees, but the idle loan will not be forgiven. The idle EIDL is a loan, so it always will be a loan. Okay. You can get additional money with the idle, the EIDL. You can ask for additional funds, and you can request this. If you already have an EIDL loan, you can go into the portal and request an increase. You can send an email to request an increase. So you've got some choices on the idle loan. Okay. If somebody had a question, if you have an LLC, and I think you're saying if you need to co-sign or guarantee a loan, are you responsible if the business fails? Yes, responsible for paying back that loan. A co-sign position, guys, you need to take that and put that in a payable in your mind. If you co-sign anything, if the person does not pay, you have to pay. So know that you have to pay. And regarding idle loan, Sonia, please check with the chat with Lauren, get into the SBDC, and we can talk a little bit more on the idle. I'm very knowledgeable on the idle loan. So with that, what we're going to do next week is I'm going to pick up on this concept of this variable. I'm going to talk about that and the gross profit, explain it a little bit more. So guys, in the meantime, think about what I said. You're going to get these slides. If you put this information together, I can't emphasize enough. You start learning how to align data, and you get an understanding of what data to extract in your company and how to align this data. You will have control of your company. You will have choice. And what will happen is you won't be going to bed going, I don't know if I'm profitable. I don't know if I'm going to have enough money. The good news is you will know. And the bad news is you will know. Guts are great decision makers with data. That's a Laurieism. Guts make good decisions, but they make awesome decisions with data. Hang with me on the weekly show. You're going to learn things like this. You're going to also hear from some guests that are coming up. I'm going to send this back to Lauren to close out. And I want to thank everybody for hanging in there as I went through this very complicated information. And my goal is to put every single small business owner in full control of their company. Back to you, Lauren.
Lori, that was such an amazing session. Thank you. It was tons of information, but it was digestible information. So thank you, thank you, thank you so much.
Good.
For all of our attendees, please check back with us every Wednesday at 10 a.m. Lori will continuously have such valuable information for all of you. If there are any questions, any additional questions, those that are listed in our chat as well as in our Q&A, excuse me, we'll be sure to get back to you. In the meantime, please email lsimpson, LSIMPSON at lbcc.edu should you like to receive a recording. And you know what, like Lori mentioned, we'll be sure to have a follow-up email, excuse me, toddler in the background, go out. And that follow-up email will include a recording to our session as well as the presentation. And again, you'll always have the ability to submit your questions. So with that, Lori, thank you again so much. Great presentation. Angela, I see your question. It's LSIMPSON at lbcc.edu. I'm going to hang on a little bit, Lori, but you can go ahead and enjoy the rest of your day. I'm going to
Please
drop
do,
in.
and anybody, if you got an additional question, put it in the chat because I will get a copy of the questions in the chat. I'm going to address them too next week as we come to this. And if you get questions that as you start look through them, put them in. We're going to answer as many questions. And I want to thank everybody for joining me for Small Biz Talk. Excited to have my show and excited to have you all part of it. I'm going to leave now. Bye.
Bye, Lori. Thank you. And thank you to all of you in attendance. Again, I'm just going to hang on so that everyone can see that email address as well as a link to submit questions and any show topic ideas. Once again, thank you. Enjoy the rest of your week. Take care, everyone. Thank you. See you next week, Wednesday at 10 a.m.